Okay, in this video, I want to discuss with you how you can avoid a market trap. Okay, so let's look at this chart. I have drawn this blue line here. By the way, this is a daily time frame chart of Starbucks, and the title is Why Should You Ignore This Shooting Star? And I will explain what I mean by that. So I have drawn this blue line here. This is the clear resistance line, and here what you have is a shooting star. Okay, as you can see, the market is going up from here, and you have this candle pattern which is called as a shooting star. So what is the criteria to identify a shooting star? If you are new to candlesticks, let me quickly help you understand how to identify a shooting star. So first, it should come after a uptrend. It's a bearish candle pattern. Second, if you look at the real body and if you look at the height of this upper shadow, this vertical line is called as the upper shadow. The height of the upper shadow should be more than twice the height of the real body. That's the condition for a shooting star. And the high of the shooting star becomes resistance. Okay. And the real body of the shooting star should be near or at the low of the candle. So every candle has got open, high, low, and close, right? So the real body should be near or at the low. So in this case, the opening price and the low price of the candle is the same. So that confirms the shooting star. What's good about this shooting star is that it also tests or confirms the prior resistance created by this particular small red candle. Okay, so that's even more powerful. That increases the probability that the market is likely to go down from here. And by the way, I am not using any indicators here like Bollinger Bands or RSI or ADX or things like that. I am simply looking at the price action. Okay. And we'll try to understand what is the market trap here. This will also help you understand why you need to learn about all the candle patterns, not just one or two candle patterns. Simply looking at one or two candle patterns and taking the trade will is not going to help you. You have to go into the details. So in this case, if you can see, if you see these two candles, between these two candles there is a gap. In Western technical analysis they call it a gap, and in Japanese candlesticks terminology they call it a window. Okay, now a window has two lines, the upper line and the lower line, and this is a rising window. The rising window becomes what? The rising window becomes support. So the lower line of the rising window becomes a stronger support. The upper line of the rising window becomes a weaker support, but the entire window is support. So now you have a situation where you have support here and you have resistance here. So what can you expect the market to do next? You can expect the price to get sandwiched between these two lines, the resistance and the support. Moreover, this candle is a bearish reversal pattern. Okay, now let me first define what reversal is. This is where most traders go wrong. Reversal doesn't mean that the price will come down like this. Reversal simply means that the probability that the price will either go flat or go down, the probability that either of these two events happen is very high. The probability that the market will go up from here is very low. That is what a reversal means. So when you see a shooting star confirming prior resistance, it simply means that the market is either likely to go flat or it is likely to go down from here. So it is all a game of probabilities. Just because you see a candle pattern doesn't mean that the price will go in your favor or where you expect it to go. It simply tells you the probabilities. And a shooting star is a very, very powerful bearish candle pattern. So now we have established the probabilities. the probability of the market going up is low. The probability of that either of these two events happen is very high. However, you know that there is a support here. So now that reduces the probability of this event happening. Okay. So to conclude, what I would say is the market is either likely to go flat, that is, I would say that is high probability, and this is low probability. This is what we know from the chart. Nobody knows what is going to happen next. At the max, what you can know is there are very high chances that the market will go flat from here. So that is why if you are planning to take a short position here, you are making a mistake. Okay. So any trader faces three possibilities when he's looking at a chart. You either go long, you either go short, or you do nothing if you don't have a position in the chart. Okay. Now in this case, there is no question of going long because you have a shooting star, which is a bearish candle pattern. We have understood that there is no point in going short because there is a window here. So it's a trap. Don't go short. So the only option that you are left with is do nothing. Just wait and see what happens next. Either it will go flat or it will continue to go up. If it breaks this resistance, which is a very powerful resistance, then you can expect the market to go even higher. Okay. So that's how a shooting star helps us establish probability. So just because you see a candle pattern doesn't mean that you take the trade. This applies to every single candle pattern. You also have to look at market context. So I discuss all of these concepts in my Japanese candlesticks trading program. You can go to this link and you will find multiple levels of training there. So let's look at what happens next on this chart. So as you can see, the next candle itself negates, this is called as negates the bearish implication of the shooting star. The moment you see this candle, you should become bullish on this chart because it has broken a very important resistance. Okay, some aggressive traders might want to just go long here and keep their stop loss below the lower line of this window, right? Going long here, keeping the stop loss here, and then letting the market do its own thing, and then the market goes up. Some aggressive traders do that. I wouldn't do it because I need a clear support and resistance level. In this case, normally if you want to go short on a shooting star, you keep your stop loss here, you keep your entry price here, and then you aim for the market to go down. But in this case, because of that window, we couldn't do that, right? So the moment the price breaks above that shooting star's resistance, it's a signal that the market is likely to go up from here, and that's exactly what happens. So this candle reduces the probability that the market will go flat after the shooting star. So you should be ignoring this shooting star because of the window that you see here. So these are the kind of chart examples that I discuss in my Japanese candlesticks trading program. You can go to this link and find the programs there. There are thousands of students from more than 170 countries are already doing that program. So check that program. I discuss thousands of examples like this in that program. So in this chart, we have discussed how you can avoid a market trap. Shooting star is a very good candle pattern. If this window were not there, then there was a potential trade here. And by the way, I have not discussed reward to risk ratio here. So even if there was no window here, let's say there is a shadow here. So your resistance point, your stop loss becomes this, your entry point becomes this, actually this one, okay? And then there is support here. So that's the risk and that's your target. So if you look at this, I think this 2:1 or 3:1 reward to risk ratio, right? So that was a good trade, a decent trade, but because of that trap, we did not enter that trade.